Welcome to our webcast, the CFO Playbook on Revenue Recognition, Finance's Role in Ensuring Compliance and Optimizing Performance. Brought to you by CFO Publishing, an Argyle company, with support from the sponsor of our webcast, Workday. I'm Joe Fleischer. I'll be your moderator. Before we get started, I'd like to outline a few features of the console you're viewing. I would note, on the left-hand side, you'll be able to view slides and polling questions throughout the webcast, and in a moment I'll go over how to respond to polls. I'll also note that you will be able to download a PDF document that comprises slides from our webcast. If you click on the link in the resource list icon area, again, you'll be able to download a PDF document that comprises slides from our webcast. Now, although we will plan to dedicate the latter portion of our webcast to addressing your questions, we invite you to type your questions and comments at any time throughout our webcast in the Q&A area of your console. Now, I had mentioned that we will intersperse polling questions. That's because you will have the opportunity to earn a certificate representing one continuing professional education or CPE credit. To be eligible, we ask that you respond to all three polling questions we will pose throughout our webcast. When we display a polling question, you are welcome to select the radio button that corresponds to your answer, and then to click on the Submit button so we can record your response. Now, after we've posed our third polling question, if you have responded to all three, and if you are eligible, therefore, to receive a certificate, you will be able to click on an icon to download the certificate in the certification section of your console. I'd like to take a moment now to introduce our very distinguished panelists. They are Eric Nakel, Senior Consultation Partner with Deloitte & Touche LLP, and Cecil Nazareth, Managing Partner with IFRS Partners. Now, by way of background, Eric leads Deloitte's Revenue Recognition Subject Matter team and provides guidance to audit practitioners and companies on complex financial accounting and reporting issues that involve revenue recognition. Also joining us, we have the pleasure of hearing perspective as well from Cecil Nazareth, Managing Partner with IFRS Partners. Cecil, as well as IFRS Partners, specializes in IFRS education, training, consulting, and conversion. And IFRS Partners' clients include CPA firms as well as small and medium-sized businesses, including subsidiaries of foreign companies. By way of background, Cecil has served as the Director of AICPA's Internal Audit and Strategy. He was also an audit supervisor with EY, specializing in the financial services industry. Now, at this stage, what I would like to do is pose the first of a number of questions we're going to direct to our distinguished panel. And our first question, which I will direct first to Eric, is the following. What are the most important developments CFOs should know about the new revenue recognition standard? And we will start first with Eric.
Joe, I'd say three things come to mind in terms of the most important. And one, working through the issues is difficult. It's the accounting requirements are complex. Often that guidance feels unclear, and how to apply the guidance is not straightforward. Two, I think it's key to understand that while it's an accounting pronouncement, the implications go beyond accounting. It's very broad, and we'll talk about that in more detail later on. But if you limit your focus simply on accounting, I think that's a formula for disaster. And third is the length of time. What I've seen is that the implementation always runs longer than you would think, and I think that's really attributable to the first two things that I mentioned, the complexity of the accounting, and two, the fact that it's much broader than simply the accounting.
Well, thank you very much, Eric. And as you've noted, we will get into more detail about these aspects, and in particular how areas throughout an organization can collaborate with finance to help an overall organization prepare for the new standard before it goes into effect. But that said, Cecil, I wanted to get your perspective on the famous five-step process for revenue recognition under the new standard. I'd like to give you an opportunity to take a moment to go through these steps, and Cecil, I will now turn it over to you.
Yeah, I'll just add to Eric's comment also. It's far-reaching. It has international compliance issues because you have U.S. GAAP and IFRS, and it's across countries and industries, and finally one size fits all. So very complex when when you come to implementation. So let's take the 5 steps that it's one of the most revolutionary standards that has hit accounting in the past 10 years in my mind. But the good news is it levels the playing field across companies, countries, and it'll make it more comparable across the globe. So let's start with the 5-step process. First is identify the contract with customer, and that implies there's a contract and there's rights and obligations, and there will be a penalty for default. I think that's inevitable in any contract, and both parties intend to fulfill their sides of the commitment. Second is identify performance obligations in a contract. So there could be a single or a multiple deliverables or bundle products, a product and a service. And America is famous for inventing and reinventing marketing gimmicks, buy one, get two free, and et cetera, et cetera. And that makes revenue recognition far more complex than it is. The rest of the world has little more easier, simpler solutions because they don't have such complex marketing transactions. Item 3 is determine the transaction price. That implies the consideration that the company expects to receive for a promised good or service, and that's pretty self-explanatory. But item 4 is a tough one. This is called allocation of the transaction price. So let me give you an example. Now, if you have a cell phone with a service, now you have to split between the cell phone recognition in the cell phone and recognition of the service. So based on the fair value of the separate components that are bundled. And that is very complex as you go industry by industry, and some sell it on a combined basis, bundle products from gym memberships to loyalty programs, to name it. The allocation is going to be a challenge. And last but not least is recognized revenue. Every CEO, CFO loves the word revenue recognition. It basically implies that when the seller transfers all the control to the buyer and the buyer starts enjoying the benefits of that product, and all the performance obligations in steps 1 through 4 have been met. So, but I'll make the last comment. 60% of the SEC cases, between 55 and 60% of the SEC cases are on revenue recognition. So that is why this topic is absolutely critical that we get right.
Well, thank you very much, Cecil, for outlining these key stages. What I'm going to do now is pose our next question, and as I do that, and before I direct this question to Eric, I want to note that Eric has written a number of articles that appear on CFO.com. The most recent of these I'll make reference to actually with regard to this question. So this question, which I'm going to direct first to Eric and then Cecil, what are the current deadlines that CFOs and their organizations need to be aware of to comply with the new standard? I'm going to direct this question once again first to Eric, and we will make reference to an article that appears within CFO.com that Eric has written. So, Eric, I will turn it over to you first.
Sure. In terms of deadlines, January 1, 2018 is a key date. That's when the standard's effective for public companies. And I think that at this stage, most companies are aware of the effective date. But I think that in terms of complying with the standard by that effective date, special attention needs to be given to the disclosure requirements. The disclosures are extensive and broad. But having said that, I think there's a tendency for people to hear that and say, yeah, I've heard that before. We'll figure it out, or something along those lines. But for the revenue standard, I would highlight 2 things in particular that I think should be noted about disclosures and implementation. The first is that the standard makes a distinction between the annual disclosure requirements and interim or quarterly disclosures. And normally, quarterly reports are viewed as interim updates of the previous year's annual report. And therefore, the disclosures are much less detailed, because the idea is that a reader would read the interim disclosures along with the previous year's annual disclosures. But in the first quarter of adoption of this new revenue standard, the previous year's annual report won't necessarily include all of the annual disclosures that are required under the new standard. And therefore, those annual disclosures need to be included in the quarterly report. So for a calendar year-end company, in that March 31, 2018 10Q, those annual disclosures would need to be included. This requirement, I think, can often be overlooked, maybe because it's not included in the new revenue standard itself. You won't find it anywhere in the new revenue standard, and that's because this requirement is not driven by the new revenue standard, but rather by SEC reporting requirements. And I know when I've mentioned this to companies, I sometimes get what I might refer to as a deer in the headlights type reaction. Bottom line is that a company can't wait to provide the annual disclosures until their annual report. They have to do that. They have to provide that information in the quarters. Another key aspect on the disclosures is what I would refer to as the incremental work that's required. And what I mean by that, I often use an analogy to try to explain this, and I use an analogy of doing a math problem. And so if you think about it, if you did a math problem, presumably you would do the work to solve that problem. And if at the end, if someone asked you to show your work, you would, the work is presumably already done. The content is there. You might need to clean it up a little bit. You might need to reformat it, but the content is there. And I think oftentimes disclosures feel like that, and companies think that, well, if we've done the work, the information must be there. And I think that's the key point, is that that's how this revenue standard and the disclosures are actually different. That it's not just a matter of showing your work like you would show your work for a math problem, but rather in certain instances, the disclosures are like a new math problem in and of themselves. And I think that's a key aspect that a lot of companies have not focused on.
Thank you very much, Eric, and I appreciate the detail that you've brought, particularly with regard to discussion about public entities and in particular public calendar year-end companies. Now, Cecil, I want to direct this question to you as well, and just as there are complexities involving public entities and in particular public year-end reporting entities, for example, there are also effective dates that would apply in the U.S. GAAP context to non-public entities and also to IFRS companies. So I wanted to give you an opportunity briefly to discuss effective dates, once again, for non-public entities and for IFRS companies as well.
Yeah, for non-public, it's a one-year deferral. So basically, it'll be January 1st, 2019. I mean, I was thinking of this when I did the first one in 2014 when the standard was first issued. I thought 18 is too far away, but now it's right around the corner. And same thing with 19. So I think the data gathering is really important. But let me comment on one more item. I think it's the approach. There are two approaches that are permissible. One is the retro and the modified retro. So if you're on the retro, you have all 3 years, 16, 17, and 18, all on the new standard. And if it was a modified retro, then you'll have 16 and 17 on the current standard and 18 on the new standard, with the difference will be mentioned in the notes. So, and for IFRS companies, the effective date is 18, but early implementation permitted.
Well, thank you very much, and that is a key point as well. Well, this is a nice transition. Before we continue our discussion, we want to pose the first of our three polling questions to attendees. And the very first of these questions asks attendees to indicate the extent to which you agree with the following statement, which is, my finance team is collaborating with other areas of my organization to prepare for changes to the revenue recognition standard. What you're welcome to do is select the radio button that corresponds to your answer, and then to click on the submit button so we can record your response. From top to bottom, the choices are strongly agree, agree, disagree, strongly disagree, or I don't know. Again, you are welcome to select the radio button that corresponds to your answer, and then make sure to click on the submit button so we can record the extent to which you agree or disagree with the statement as it applies to your organization, namely, my finance team is collaborating with other areas of my organization to prepare for changes to the revenue recognition standard. What we'll do is give you just a few more seconds to respond. Then what we will do is reveal how you have responded and then continue our discussion. And so far, what we can clearly see is that among respondents, yes, a majority either agree or strongly agree, but roughly 12% have indicated strong agreement. Clearly more than half, at the very least, agree. But I would also acknowledge more than a quarter of respondents either disagree or strongly disagree. And so with that in mind, I think it is now time to pose our next question for panelists. And this question, which is a very important one, is one that I'm going to direct first actually to Eric and then to Cecil. And that is, outside the realm of finance, with whom should CFOs collaborate within their organizations to prepare for changes to revenue recognition rules? First Eric and then Cecil.
So, Joe, I think as we talked about before, one of the keys to the implementation of this standard is the fact that it is broad and it goes beyond accounting. And I think on this slide, we've highlighted a few of the other areas that are that come up as being directly impacted very often. And I think we'll talk about some of these in some more detail as we move on. I would highlight here perhaps IT and system requirements. What I've seen is that oftentimes as we talk about the implications and we start talking about how it goes beyond accounting, IT seems to be something that comes up over and over, and it seems to create what I would maybe describe as a sense of urgency and creates timing issues. And I think what we hear is that as we're talking about the accounting implications, a company will observe that the current system that they have can't get the information that's needed or can't process the transactions as is being required. And so they need to put in a new system or make significant changes to the existing system. And anyone who's been involved in that knows that process is an involved process. They have to put the system in place. The system has to be tested. And I've observed time and time again that the IT requirements seems to drive the whole process, because as someone starts looking at the timeline and they back into it, they realize, wait a second, if we need to make these changes to our IT system, that's going to take a certain amount of time, and we need to have enough runway to get that done.
Thank you very much, Eric. And indeed, we are going to elaborate specifically on IT as well as these other areas. Cecil, I know you've been a big proponent of making sure that an entire organization is running on all cylinders, as it were. Cecil, what would you add to Eric's commentary?
Yeah, I agree. It's not an accounting issue. These are not journal entries. This is not proprietary to the accounting or finance team. You really want to embed this in the whole company. So to give you an example, sales, right? It's not on the slide, but sales commissions, they are really important. How do you tell the salesperson, oh, because I recognize revenue late, your commission is going to be next month and not this month, right? You got to educate them as to how does the revenue recognition standard impact them and their paycheck. At the end of the day, they're all working for a paycheck, and the last thing you want to do is throw an element of surprise that they don't get their commission. So I'm working with 2 or 3 companies as we speak, a real estate company, a software development company, a licensing company, software licensing company, and all of them are facing this situation where there'll be commissions or deferred commissions, and someone needs to get there and get a handle on all this. And I'd agree with Eric, the IT is never brought into the loop till it's too late, and then they start figuring out, oh, let's do a backdoor approach, or let's try to fix this, when they should have been part of this equation all along.
Thank you very much, Cecil. And I just want to call attention to compensation arrangements. I'm glad you've brought that up. That's key. And indeed, we're going to discuss compensation arrangements a little later on. Before we do so, I'm going to pose this next question to you, Eric. And this actually involves multiple parts. First, we're going to talk about project management, but then we're going to talk about revenue streams. That said, Eric, the overall question is, how can a CFO take the lead in establishing a roadmap for all areas of an organization that are affected by the new revenue recognition standard? I think this requires a 2-part answer, and with that in mind, I'm going to direct the first half of this to you, and then we'll continue our discussion regarding revenue streams.
So, Joe, I think that establishing a PMO seems to be a best practice, and I think that PMO, several things that I've seen that work well, is that it would be, led by senior folks in the organization, and it certainly seems, as we've talked about before, because of the broad implications, that PMO should be broader than accounting. It should include, IT, legal, HR, people involved in controls. Cecil mentioned sales commissions. So I think you want a lot of different aspects of the organization that are represented in that PMO. I think that having frequent status updates and kind of target dates, so to monitor the progress, is important. I would also say that coordinating with the auditors as you go is important as well, not just at the end. I think one of the things that we have seen is that the whole implementation process is a journey, and to wait until the end to get whether it's internally within the organization, say IT or HR involved, or the auditors involved at the end. That seems like it's a mistake because that can tend to lead to unexpected surprises. So if I were to sum up, I think that the first step really is in establishing that PMO and having frequent updates and monitoring.
Well, thank you very much, Eric. Second half of this discussion, which is very key as well, is revenue streams. And you had also written an article, Revenue Recognition, The Clock is Ticking, which is available on CFO.com as well. And I'd like to give you an opportunity to elaborate on what organizations need to do with regard to analyzing revenue streams.
Yeah, so I think what happens is once an organization says, okay, fair enough, we really need kind of all hands on deck. We need to get we're going to set up a PMO. We're going to get the different aspects of the organization involved, and it's going to be senior led, all that. Then there tends to be this, okay, well, but what do we actually do? How do we actually tackle this? And I think one of the things that I often recommend and that I've seen companies do successfully is identify the different revenue streams that you have. Identify those different revenue streams and then take sample contracts from those revenue streams and work them through the model, the new revenue recognition model. And what that tends to do is that will flush out where there are tension points or questions that come up as you try to apply the new accounting standard. And oftentimes when someone comes across those tension points, those questions, that may require more work. That gets back a little bit to what we talked about in terms of it takes longer than you think. I think it may require more work, and that very often what I've seen is that that work can involve some outreach, some further discussion. Sometimes the outreach might involve, there's I believe 16 AICPA working groups that have papers and that are published. Some are still in the drafting stage that provide additional guidance in addition to the standard. There's also the Transition Resource Group, or TRG, has published a number of papers, and there's minutes available on the FASB website that provides additional guidance. I've seen companies do informal FASB inquiries. I've also seen a fair amount of implementation projects that involve a company will look at a revenue stream, run into some issues, and they reach out to peer companies and, are you running into this, and how have you thought about that? And there tends to be dialogue with that, and all of this, of course, coordinated in some way with the auditors. And so I think that it's that working through the revenue streams having that, seeing where the tension points are, having this additional outreach or inquiry, as I just mentioned. And then if you think about the whole PMO, it all ties back because you then say, okay, well, here are some of the tension points that we're running into from an accounting standpoint, but what is this? Does this have implications from an IT standpoint? Are there implementation issues we need to think about from legal or HR? And so all those things kind of come together, which is why the PMO is so important in terms of monitoring the whole implementation process.
Absolutely, and it models organizational behavior and makes it clear that revenue streams permeate throughout an organization. And actually, we're going to now dig into one particular aspect of organizational collaboration, and that's finance and IT specifically. And Eric, I'll direct this question first to you and then to you, Cecil. How should finance and IT teams work together in particular to ensure they collect, maintain, and have sufficient visibility into information their organizations must report to comply with the standard?
I think that to work together, I would focus on what we talked about on the previous slide, and that is the communication along the way and the importance of the frequent updates, and that both the finance department, IT, both be part of the journey along the way to avoid those unexpected surprises. I would also come back to a point that we talked a little bit about earlier on, which is the disclosures. And I think I would mention again not to overlook disclosures, that oftentimes the information that's needed for the disclosures is not information that's going to come through as part of the implementation of the accounting standard itself. And so it does raise a question of, well, can the system accommodate those requirements? Are there additional information that's required that the company is going to have to obtain that will require some system modifications? And I think that along the line of disclosures, sometimes the disclosure requirements, that information can be looked at and evaluated kind of in a parallel work stream. It's not necessarily sequential in the sense that you don't necessarily have to wait until you've implemented the accounting standard to start thinking about disclosures, but rather certain disclosure requirements can be evaluated as the accounting implementation is going on, and those can be coordinated at the same time. And I think that's why looking at the disclosures and the coordination between IT and finance is particularly important as you go about implementing this particular standard.
That's a really key point, Eric, that there's not necessarily always a need for a sequence, if I'm understanding correctly, that it is often necessary to consider what you're doing as far as any identifying the need for modifications as you're preparing. Cecil, what would you add to this discussion?
Yeah, I would add, I think Eric is right on point. I believe what I'm encountering when I'm consulting with these clients, the revenue streams are absolutely important. And the delivery channels, I would go to another level. For example, you're talking retail stores versus online. How do you recognize revenue in the two channels? Here's a case in point. We are working with a software solution provider. So they have 4 or 5 different models, and the business models have changed. So they sell desktop, they sell SaaS, they sell cloud, they sell licensing. So there are like 6 different models they're selling their software through the delivery channels, and each one requires a specific contract and go through the 5 steps in each of these categories. So it makes it more tangible. So the very fact that you've been doing business, or you don't just, the biggest challenge I'm facing is they assume that whatever they're doing currently fits into the new standard. They call it a default approach, but it's furthest from the truth. You really have to take each revenue stream and go through the 5 steps and say, okay, now we are satisfied that this meets the revenue recognition definition in each delivery channel.
Well, thank you very much, Cecil. And indeed, this leads into our second of three polling questions, which we will direct to our audience. And our second of three polling questions asks attendees to indicate the extent to which you agree with the statement, "My finance team is coordinating with other areas of my organization to adapt performance criteria in the context of new revenue recognition rules." This is what we're going to be elaborating on very shortly. What you're welcome to do, those who are joining us, is select the radio button that corresponds to your answer and then click on the submit button so we can record your response from top to bottom. The choices are strongly agree, agree, disagree, strongly disagree, or I don't know. And after you select the radio button that corresponds to your answer, we do ask that you click on the submit button so we can record the extent to which you agree or disagree with the statement as it applies to your organization. My finance team is coordinating with other areas of my organization to adapt performance criteria in the context of new revenue recognition rules. Again, we do ask that you select the radio button that corresponds to your answer and then click on the submit button so that we can record your response. We'll give you just a few more seconds to respond. We will display how you have responded and then continue our discussion. And so far, what we can see is there is somewhat lukewarm agreement here. Overall, majority, but a rather slim majority, either agree or strongly agree. Indeed, fewer than 9% of respondents strongly agree. And I would acknowledge that more than a quarter of respondents at least disagree. Indeed, a total of more than a quarter either disagree or strongly disagree. And so this leads into our next question, which I'm going to direct to Eric. And then what I will do is we're actually going to cover different aspects of this question, and I'm going to direct this question to Eric initially, and then I will invite some additional commentary from Cecil thereafter. But with that said, Eric, how would you address the question how CFOs coordinate with sales, legal, and human resources teams to adapt performance criteria in the context of new revenue recognition rules?
First, focusing on legal and what's the implication of legal. The thing that I see most often that involves legal as part of the implementation of the new revenue standard is the contractual terms. And what I mean by that is there's certain provisions in the new revenue standard that might take on an added importance when you think about the contractual language. So for example, a fundamental question in the new revenue standard is, do you recognize revenue over time or at a single point in time? In other words, do you recognize revenue when I deliver the product or as I make the product, to simplify it that way? And the standard introduces concepts such as, does the entity have a right to payment as the product is being manufactured? And does that right to payment include a profit margin? Now, oftentimes, a contract may be silent in terms of the language around that particular provision. Maybe it does include some language, but contracts as they were written, 3 months ago, 6 months ago, 3 years ago, whenever, didn't contemplate those provisions in the contractual terms. And yet, the new revenue standard places emphasis on this whole notion of, do you have a right to payment? Do you have an enforceable right to payment? And does it include a profit margin as that is occurring? Companies need to look at, well, what do our contracts say? And is it clear? Is it not clear? Does it need to be revised, modified? What are the implications? And of course, changing the contractual language of a contract is not necessarily a unilateral thing because, of course, the customer needs to agree to that. So I think that's an example of where understanding the accounting requirements and coordinating with legal becomes very, very important. I think the same can be said around termination provisions and what happens around termination. What if the contract gets terminated? What if it's the customer who terminates it? What if it's the the vendor that terminates it. What happens? What are the different rights? Again, that has, in certain instances, taken on increased importance in terms of the accounting, and oftentimes the contracts weren't necessarily structured that way. And I think it requires a company to take a hard look at their contractual language. So I would sum up the legal aspect of this in terms of contractual terms. And then I think the second part of your question, Joe, was around human resources and compensation. And here, when you talk about human resources, different things come to mind for most companies. Usually the first thing that comes to mind when you talk about resources, companies think about, staffing and, do we have enough resources to get this done? Do we have the resources in-house? Do we need to get some advisors and so forth? But I think that an interesting aspect that impacts some companies, not all, but I've seen this become a significant issue for a number of companies, is when a company has some type of bonus arrangement, some type of compensation plan. And if you think about it, normally most bonus arrangement, compensation type plans, oftentimes there's some sort of a link towards a revenue metric. It can vary, but oftentimes you're going to see something around sales growth, margins, EBITDA, something that has a link back to revenue. And now with the new revenue standard, said simplistically, one might say, well, there's a different way of keeping score. And so we set up this bogey of how we were going to measure performance. Well, now we've got a different way of keeping score. And let's say that bonus arrangement, extends, a couple years or something like that. What's a company going to do? They probably didn't contemplate that when the original arrangement was put into place. And I've heard companies talk about, two potential things. One is, change the arrangement, change the plan. Now that's not always obvious because there's legal implications of how do you do that and how do you get that done from a legal standpoint, and does who needs to agree to that and so forth. But if you don't change the plan, the other seemingly possible solution is that you effectively have two sets of books. And what I mean by that is that in order to measure the metric of this bonus arrangement, you would do that under the old accounting rules, under the old revenue recognition standard. But for purposes of financial reporting, you have the new revenue recognition standard, which is what you have to use in your financial statements. And that can be a significant burden for companies if they're going to somehow keep score two ways, if you will, two sets of books. That can be a very significant undertaking. And I think that this can be a real issue with real life implications. And I think companies would want to think about that if they fall into this situation, so that this isn't an afterthought that you're dealing with at the end of the implementation process.
Thank you very much, Eric. And before I move on to Cecil, just to clarify that last point, that last bullet, you've outlined one possible scenario, essentially where an organization retains its existing compensation program, but in effect maintains two sets of books. Would you, and I think you had also alluded to another scenario, which is potentially changing a compensation program. Would that be challenging in many cases for organizations?
I think changing the compensation program can be very challenging because that involves, since you already have a contractual arrangement with whoever is the party that's receiving that compensation. You can't do that unilaterally. In other words, a company can't simply say we're going to change it. I think there needs to be buy-in that has legal implications, and so I think that is complicated and certainly something that a company would want to get ahead of.
Thank you, Eric. Cecil, you had alluded to sales and compensation earlier. How would you elaborate on what we've discussed so far in terms of organizations, or rather finance collaborating with other departments within organizations to prepare before the new revenue standard goes into effect?
Yes, a couple of suggestions, and we are working through and helping several companies, especially the non-public companies, comply with the new standard. So, for example, human resources, I would get the human resources to have more of an educational training sessions, or I would say educational sessions to educate the rest of the employees as to how it would affect their compensation, in non-technical accounting terms. You cannot go up there and teach them about the 5 steps, etc. You just want to say, today your compensation is X, and you get this in December, whereas the new standard requires that we recognize revenue in Jan, so you're going to be getting your compensation in Jan. And that educational piece, I think HR can fulfill that role. It's a little tough subject, but someone's got to address it, or the CEO or CFO got to take that on. The second one is, there are changes, for example, accelerated revenue versus deferral of revenue. For some industries, the new standard, like the software industry, revenue can be recognized a little earlier than under the current standard, whereas in the auto industry, it may be a little more deferral. They are leaning more towards the revenue will be recognized a little later on. So you got to educate people in the company in non-technical accounting terms. That'll go a long way. And finally, the point of time versus period of time, and I know Eric alluded to this also. If you're in software revenue recognition or something similar, is it multiple deliverables? When do you recognize the revenue? Is it that point of time? For example, in software, at the time you sell the software and you have rights and control over the use of any part of the system, it's a point of time sale versus if I have frequent updates to that software, then it totally changes the facts and circumstances. And there again, you need a contract or a legal to opine on how is this contract written, and how do you understand the standard as to whether it's a point of time versus a period of time contract.
Thank you very much, Cecil. And these are important subtleties. And indeed, given all these subtleties, begs the question, what are the most significant obstacles CFOs and finance leaders in general and their organizations are likely to encounter with complying with the new standard, and how can they overcome these obstacles? Eric, I'll direct this question first to you and then to Cecil.
I think in terms of the obstacles, I think we've talked about a number of different obstacles, and if I were to say, what are the primary obstacles, I would come back to the accounting complexity, and not to underestimate how difficult it will be to resolve issues. I know sometimes it's hard to comprehend why that would be, but there is uncertainty around how to apply this standard. And the second thing in terms of obstacles is what we've really been focusing on, is the whole idea that it's beyond accounting, whether it's IT, HR, legal, controls. It'll vary by company, which ones are more significant, but it will have an impact beyond accounting. I think that one of the other things that's on this slide that I think is something for companies to think about is this notion of educating stakeholders. And Cecil made reference to, do you apply full retrospective, modified retrospective? And I think that while a company is going through its own implementation process and what they need to do, one of the things that's important to not lose sight of is the fact that this is going to change how a company recognizes revenue. And it might, for certain companies, it might accelerate revenue, it might defer revenue, but for most companies, there will be an impact. And when stakeholders are looking at that company and evaluating that company, whether it's analysts, shareholders, whatever, they want to be able to compare the company from, one year to the next, one period to the next, and also be able to compare one company to another company. And so this notion of somehow having comparability, and how are you going to have comparability if you've changed the way you're recognizing revenue, if said another way, if you've changed the way you keep score, is an interesting question. And I think educating analysts and shareholders to understand, when you implement the new revenue standard and you say, well, sales went up 15% or sales went down 10%, you've implemented the new revenue standard, and the obvious question that's going to come along is, well, how much of that 15% increase is because you changed your revenue recognition method, and what would it have been if you had the same revenue recognition? Because otherwise, stakeholders, analysts, they don't really know if it's misleading information or not. So I think that's an important point about how will a company educate the stakeholders about what's really happening in the business and what are the true trends.
That's a really key point, Eric. I want to thank you for noting that, because that has a fundamental effect on perception of performance. And actually, before we move on to our next question, Cecil, I'd love your perspective, particularly on the point that Eric had highlighted, the need to educate stakeholders.
Yeah, I echo the same comments, concerns. I think like we said all along, cross-functional teams, PMOs, the auditors, stakeholders, nothing affects people more than their paychecks there. So compensation is an issue. With stock options, warrants, if they are tied to revenue recognition, ultimately it's the bottom line, EBITDA or EPS or stock options or whatever. They need to understand that computation, not in detail, but how would it affect their paychecks, number one. Number two, I really think there are data gaps, and we need to focus on that. I fully agree with Eric. Until you do a dry run, you will not know what is missing. So when I'm working with companies, I actually tell them to create a pro forma in the new standard and say, okay, now are you satisfied? Here's how it meets the new standard requirements. So by actually doing a financial in the new standard, you can see the delta between the new and the current standard. And the second comment I'll make, I work with international companies. So in the U.S., I think we are pretty solid because a lot of the U.S. GAAP rules came in to the new standard. So I think we have a little better handle. But when you go to the international companies, for example, Europe and the rest of the world, they are still catching up to our concepts of the 5 steps. Because their standard was a little different, so and their disclosures also will need a little more work. So that is where I see the challenges being need to overcome some of those challenges which will be posed by this new standard.
Thank you very much, Cecil. We're now going to pose our last question for our panel, and actually, Cecil, I'll start with you, and then Eric. Cecil, and then Eric, what are key recommendations attendees ought to remember from our discussion?
Two or three comments. The first one is deadline is fast approaching. I cannot believe that we are doing this session literally 5-7 months away from the implementation, close to implementation deadline. I remember, like I told you, Joe, doing this in 2014, I thought the deadline was really far away, but it's crept up on us. So I think we got to focus real hard and tight. Second, data gaps. I still feel, as I'm working with companies even today, they still have a few issues that they can wrestle with. And finally, disclosures. I think I definitely agree with Eric. It looks easy, but when you start writing it and you see it, you're going to find a lot of gaps, and you need to focus a little more on that.
Thank you very much, Cecil. And then moving on to you, Eric, what would you want attendees to come away with? And I just want to note for our audience, after we address this question, we'll pose our third polling question, and then we'll address some questions from attendees. But before we do so, Eric, what would you want attendees to come away with from our discussion?
As I was thinking about this, Joe, I started to look at what would be kind of the 3 main themes that I think someone should come away with. I think one is that you need involvement beyond accounting. We've mentioned that a number of times, but it's broader than accounting. You need involvement beyond accounting. Otherwise, I personally believe that the implementation will not be successful. It has to involve folks beyond accounting. Thing one. Two, it will take longer than you think. Maybe that's not unique to the revenue recognition standard, but I've seen this time and time again that the implementation, despite the efforts that a company might undertake, it takes longer than you think. It's just more complicated, more pervasive. It takes longer. And as a result of those first two, a third thing, and I think Cecil made reference to this, is to be proactive, to implement, to now not, if a company has started and is already down the path, keep the foot on the accelerator and keep going. If a company is maybe lagging a little bit behind, it's time is of the essence. The runway is getting shorter, and a company would want to be proactive and get moving, because I think that companies that procrastinate, that underestimate the time, a fire drill will occur, and that end date is approaching. Cecil's made a few references to that, how it's fast approaching, and I guess along those lines, Joe, I would maybe respond to a question that I've heard, which is sometimes I hear companies, individuals ask, do you think there's a chance that the standard might be delayed? And I'm in no position to say what anyone else might do, but certainly there's no indication whatsoever that I'm aware of that the standard's going to be further delayed. So the dates that we've talked about, those are the dates, and a company can back into the timing, but while 7 months or whatever might seem like you still have some time, it is fast approaching.
Thank you very much, Eric, and I do appreciate your emphasizing the involvement beyond accounting and the need to move quickly and proactively. Now, what this leads into, first of all, is our third polling question for attendees. Then we'll address some questions from attendees. Our third polling question for attendees asks, and this is a third of three polling questions, within what time frame, if any, does your organization plan to get ready to implement the new revenue recognition standard? What you're welcome to do is select the radio button that corresponds to your answer, and then click on the submit button so we can record your response from top to bottom. The choices are: we're in the midst of getting ready, later this year, after next year, my organization is not planning to implement the new standard, even though it is applicable. The new standard is not applicable to my organization, or I don't know. And again, what attendees are welcome to do is select the radio button that corresponds to your answer, and then please make sure to click on the submit button so we can record your response to the question, which is: within what time frame, if any, does your organization plan to get ready to implement the new revenue recognition standard? What we'll do is we'll give you just a few more seconds to respond. We will then reveal how you have responded in aggregate, and then we will address some great questions we've received from attendees. And so far, what we can clearly see from among respondents to this question, what we can clearly see is the following, which is that kudos to roughly a quarter of attendees who have indicated you're in the midst of getting ready. About a fifth have indicated later this year. Now, there might be some companies that are non-public entities, so there might be time for some of these, and some have even indicated that the standard is not applicable, but I would bring attention to the quarter of respondents, approximately, who've indicated you don't know. Well, you've come to the right place. And indeed, what we now want to do is address some great questions that we have received from attendees. And I think one really key question that we do have to consider is, and this has to do with the question of recognition over time. And perhaps, Eric, I'll direct this first to you. This is a general question, which is there anything that distinguishes, this is a recognize over time guidance, anything that distinguishes reasonable profit margin, for example, is that something that you would be comfortable addressing, again, in reference to the recognize over time guidance in the most general sense as far as what would qualify perhaps as reasonable profit margin? Is that something you're comfortable addressing in this context?
Sure. So the basic guidance around over time is that you have to be entitled to payment during the process, and that payment has to include what's referred to as a reasonable profit margin. And specifically, what that means is that if you were entitled to payment, but the payment was only for your costs, so the cost that you've incurred, but it didn't include profit margin, you would not meet the criteria to recognize revenue over time. So you need to have a profit margin. So then the question becomes, well, what is a reasonable profit margin? I don't know that there's a bright line that says, well, this is a reasonable profit margin, this isn't. It depends obviously by industry, by contract, and what are the specific terms. One thing that I would observe is that I don't believe that when you think about reasonable profit margin during the production process, I don't believe that profit margin would necessarily need to be the same as the profit margin that a company might get on the finished product. So, for example, if the finished product had a 20% profit margin on it, I don't know that you would necessarily need to have a 20% profit margin during the work in progress component. I don't think you'd need to necessarily have that same 20% in order to meet the reasonable profit margin criteria. So I think it can be different. That said, if I were just to throw out a number, if 20% was the profit margin on the end product, and you only had a 2% profit margin on the WIP, I think that would call into question, is that reasonable? Someone could try to explain why it is, but I think it would call into question in that particular situation, is the 2% a reasonable profit margin?
Thank you very much, Eric. I think we have time for one more question from attendees, which I'll direct both to you, Eric, and then Cecil. An attendee asked, this new standard, first, it's a two-part question. Does it only cover contracts entered into subsequent to January 1st? And I gather that would be January 1st, 2018, presuming this is a public entity. Now, if not, do companies need to evaluate existing contracts and potentially restate prior revenues? So let me direct this question. I know it's a broad question that could have a lot of different answers, but let me direct this question, if you're okay, Eric, first to you and then to Cecil. And I think this will be the last question from attendees we will address.
I think the simple answer is that I forget exactly how you phrased the question, Joe, but yes, it does apply to contracts that were entered into before January 1, because if you think about it, a contract that was entered into before January 1 but is still ongoing, the requirement is, of course, it depends on what adoption method you select, but you're going to have ongoing activities, and so therefore those ongoing activities are going to be subject to the new standard, and you would need to consider the new standard for those unperformed activities. Maybe I'll stop there and let Cecil comment.
Yeah, I agree with Eric. It applies to all contracts as long as they're current, and it has to be, there's some part of the performance obligation has not been fulfilled, right? So if someone was delivering oil or gas or whatever, and this contract was 5 years ago, but they still have an implied contract to keep delivering gas till such time as you tell them to stop. So you would have to apply the new guidance to that contract. So it applies to all contracts, not just the ones after 2008.
Thank you very much, Cecil. Thank you very much, Eric. I want to acknowledge we have received so many great questions from attendees. We may not have had the opportunity to address all questions during the course of this discussion. We will plan to follow up on any remaining questions after our webcast. In the meantime, a few things. First of all, in addition to thanking our distinguished panelists and thanking attendees, I do want to thank the sponsor of our webcast, which is Workday. We'll briefly display some information about the sponsor of our webcast, which once again is Workday. And just a few follow-up items. I would note that this webcast will be available on demand later this week within the webcast section of CFO.com. At that point, you'll be able to view and listen to a streaming archive of our webcast. Also, you'll be able to download a PDF document that comprises slides from our webcast. And if you're eligible, if you're not able to retrieve your certificate now, you will be able to do so when this webcast is available on demand later this week. I would also note that at the very end of our webcast, we will invite attendees to complete an online feedback survey, which will be visible in a separate browser window, which you will be able to view if you've turned off your pop-up blocker within the web browser that you're using to view and listen to our webcast. As always, we appreciate your feedback. I'm Joe Fleischer, moderator of our webcast, and on behalf of our very distinguished guests, Eric Nakel, Senior Consultation Partner with Deloitte & Touche LLP, and Cecil Nazareth, Managing Partner with IFRS Partners, we very much appreciate your joining our webcast. The CFO Playbook on Revenue Recognition, Finance's Role in Ensuring Compliance and Optimizing Performance, brought to you by CFO Publishing and Argyle Company, with support from the sponsor of our webcast, Workday. We thank you for your time, and we hope you enjoy the rest of your day.